Okay, so welcome back. At this point, are there any questions? Are there any questions?
Yeah, so my question will be, what will be your deliverables under each stage? To this stage.
Are you referring to the analytical procedures?
No, right from the beginning, right from the initial meeting with the client or the pre, what is expected to be your deliverables as part of evidence of work done?
Okay, so during the pre-audit research, you normally have a documentation in practice, you normally have a documentation in Excel that you prepare based on the risk assessment you have done. Okay, so during the pre-research stage or the pre-contact procedure stage, you normally do, in analyzing the information, you even employ ratio analysis and other analytical procedures just to explain to your supervisor the trends and the risk you see in the taxpayer's business. So that a report is done, which is reviewed internally. Then during the tour of business and the initial interview or the initial visit to the taxpayer's office, you take minutes and take notes, which forms part of your risk assessment notes, okay, which can be placed on the audit file as part of your planning procedures. So basically, that should be your deliverables.
Okay, sure.
All right. Now let's look at ratio analysis. I believe.
Mr. French, I have a question.
Okay, yeah.
Okay, so for instance, in an instance where GRA has done their initial risk assessment of the company and they have some pre-information about the company, but during their meeting with the company or throughout the week, their assumptions or however they plan is not as it should be, what happens?
Good. So one thing I always tell my auditor colleagues or friends is that risk assessment is iterative. You can even do risk assessment at completion stage. Initially, all your assumptions and whatever you were looking at from the planning stage was to know whether there are some risk in the taxpayer's business that would impact your risk assessment and how to approach the audit. It is good to know that in the middle, if things change, okay, even sometimes not even at the tail end of the planning stage, but even at the execution stage where you start proper field work, you'll be privy to some new information that you didn't know at the planning stage that would have to change your approach. So as auditors, anytime there's a change in information, there's a change in assumptions, or there's a change in our initial perceived risk assessment, we need to retune our approach. So as auditors or tax auditors, what you do is anytime there's a change in your risk assessment based on new information you are privy to, you need to change your approach. You don't stick to the old approach that we have planned, and because you have planned, we feel everything is fine. Maybe let me give you a typical example where you do your planning and all that, you think everything is fine. You go to the taxpayer's office to do field work. You chance on a letter that was issued by maybe their financial auditors, a report issued by the financial auditors stating that the company's accounting system is wrong. All revenues that the company captured in their financial statements is not actually correct because the system posts revenue to some other system and it doesn't capture correctly. So they have a system with their accounting software. As a tax auditor, if you go and find out this, won't you trigger all attention to audit looking into the revenue of the company? Well, it means that if initially you assign, let's say, CIT, corporate income tax to a junior associate member because you realize that there was no risks there. And maybe you realize that there were more risks in PAYE because they weren't paying their payroll taxes on time and they had maybe some undisclosed bonuses and all that. You tell the lead of the team to quickly take over the CIT and look into the revenue and assist the junior associates to work on payroll if there's some time, but the focus should be on revenue because that is the issue with the accounting software not recognizing revenue properly, understating revenue. It is something of key interest. So at that particular point, tax allocations could change. Your plans changes. Do you understand?
Yes, please.
Yeah.
Thank
okay.
you.
Welcome. Yeah. So moving on, let's look at ratio analysis. Ratio analysis is also used to identify risks. That is the motive of doing ratio analysis. It is part of what we use to identify risk when analyzing taxpayers' information. Now, ratios can be grouped into 4 main ratios, 4 broad class of ratios. So we have the profitability ratios, liquidity ratios, activity or efficiency ratios, leverage or gearing ratios. Then the fifth one, investment ratios, okay, which we can also talk about. Now, let's look at profitability ratios. Ratio analysis is something that the examiner really likes. And at most, every 2 sittings or 3 sittings, a question on ratio analysis drop. So let's note it well. When we talk about profitability ratios, as the name suggests, we are looking at how profitable the company is. So this ratio is to analyze taxpayers' information to know whether this company is profitable or not. There are 2 key ratios or 3 key ratios here. That's normally people benchmark against profitability ratio anytime they want to analyze taxpayers' information. So the gross profit margin, return on capital employed, and net profit margin. At our level, we are not expected to know the formulas. It is more of interpretation. But I have seen sittings that the examiner wants us to compute. In like 90% of the instances, you will not be asked to compute. But I don't want my students to take chances. So let's familiarize ourselves with the formulas. So I'm sure any of us who have the material, we have a lot of questions to solve on ratio analysis. But maybe before I end my topic on ratio analysis, or as I explain, I'll bring out some questions so that we can all answer together in terms of interpretation. But let's note the formulas. So for gross profit margin, we are looking at gross profit margin. How much margin do you make of every CD of sale you do? Are you listening? So we are looking at how much margin or how much profit you make on every CD of sale you make. So it is sales or turnover or revenue divided by your gross profit. Okay. Now, we are looking at this ratio to be able to help us identify the consequence of what we call gross profit. So if I say gross profit is given by the formula revenue minus your direct costs or your cost of sales. Now, if you deduct your cost of sales from revenue, you are getting your gross profit. So let's say in a first year, so let's say 2023, the company computed its gross profit margin, which is your gross profit over your revenue, giving us 40%, okay, 40%. Then in 2024, the company is computing gross profit margin as 60%. It means that the company is making 60% of every sale it makes in 2024. And for 2023, the company was making 40% of its sale. Okay. Now, when it happens that way, the higher the gross profit margin, the better it is for the company. So it means that the company is doing well. So that will be your concluding statement or your concluding analysis. If we pick net profit margin, okay, net profit margin, we are looking at the net profit divided by the revenue or sales that the company is making. If you say net profit margin, net profit is made up of gross profit minus your indirect cost, which is your general and administrative expenses. So in your commentary, you realize that net profit margin is impacted by your general and administrative expenses. So if your general and administrative expenses is increasing not commensurate to an increase in revenue, it means that, in other words, you are going to experience a smaller net profit margin because then your indirect expenses have gone up. So in analyzing net profit margin, we are saying that how much net profit a company is making out of every sale it makes, every CD of sale it makes. Okay. So normally in analyzing this, your net profit margin can reduce or increase depending on the fluctuations you have in your revenue and your net profit, which is basically dependent on your general and administrative expenses or your indirect expenses. And also for gross profit margin, we are also looking at the impact of cost of sales on revenue, because the higher the cost of sales, the lower your gross profit, and the lower your cost of sales, the higher your gross profit. Okay. Return on capital employed. Here we are looking at all the profit that the company has employed in doing business, all the capital that the company has employed in doing business. So we have normally companies in terms of capital uses debt and equity. So if I say debt, I mean the company going for long-term loans and all that. Then equity is talking about the stated capital and the company's income surplus or retained earnings. So if you are looking at return on capital employed, we are looking at how much the company is getting on all the capital that it has employed to do business. So this is also computed by looking at the profit before interest and tax divided by your capital employed, which is made up of your long-term debt, which is your long-term loans, plus your stated capital, plus your retained earnings or income surplus, times 100%. So if your return on capital employed is increasing from, let's say, 20% to 40%, it means that the company is getting more returns in the capital that it has employed, and it is good for the company. Okay. All right. Let's look at liquidity ratios. Liquidity ratios explains how the company is able to sort out or address their short-term obligations as and when they fall due. So companies have short-term obligations in terms of taking short-term loans, paying suppliers, credit facilities, and all that. How is a company able to settle off these short-term obligations as and when they fall due? This is seen in two basic ratios, which we call the current ratio and the quick or acid test ratio. So let's look at the current ratio. The current ratio is just looking at current asset over current liabilities. It's to 1. So because it's a ratio, the ratio is benchmarked is to 1. So if I say it's to 1, I mean that when you divide your current assets over your current liabilities, whatever figure you get, you are going to ratio it to 1. So it's to 1. Now, the idea is that the ideal situation should be 2:1, where a company's current assets can pay for the company's current liabilities twice. So if you have your current asset over your current liabilities to be 2, right? So let's say your current asset is 100,000 divided by your current liability of 50,000. It means that you are going to get 2. So you have 2:1. The understanding for the ratio of 2:1 means that your current assets can cater for your current liabilities 2 times. If you have 1:1, it means that your current assets equals your current liabilities, and as a result, the company is paying all current liabilities with all its current assets, which might not be a good thing for the company. So someone should interpret a current ratio of 0.5:1. Let me see if the understanding comes clearer. Anyone to give a try? 0.5:1 current ratio. Abigail.
Yes, please. It means that your current asset can pay for only half of your current liabilities.
Thank you. Thank you. That was right on point. That was right on point. So as we compute these ratios, we are able to interpret it and give an understanding of what these ratios mean. Now, quick ratio, which is also called asset test ratio, is looking at how your
Hello,
most... Yes.
Hello, sir.
Yes.
Yeah, wanted to ask a question. I don't know if it's the right time.
Okay, ask.
Okay, so if you are conducting the ratio analysis for risk assessment procedures, then after that interpretation, shouldn't we look at the risk itself that it poses regarding tax obligations, and also it's not like financial analysis?
Okay, so
or company performance.
So as I said before I started with ratio analysis is for risk assessment purposes. So based on the information you find from your analysis, then you are able to know, because the idea is risk assessment. Interpreting the ratios, after interpreting the ratios, it helps you bring out like possible risks that can occur in the taxpayer's business. Okay. So let me give an example for, let's say, profitability ratio, gross profit margin. The company, you realize that the gross profit margin for some time has been dropping, right? It means that the company is not making much gross profits over the years. It has been dropping massively. But this same company is out there in the news taking awards for getting high revenue and all that. Are you listening carefully?
Yes,
please. And from their revenue, you can see that this company is making a lot of improvement in their revenue over the years, but their gross profit margin is dipping. What is that telling you? It means that the cost of sales might not entirely be genuine. There are some cost of sales that is impacting the gross profit, because you can be making high revenues, but the gross profit will reduce if your cost of sales is extremely high as compared to previous periods. So then the risk here is that then the company might have maybe costs of sales that are not genuine, that are not wholly, exclusively, and necessarily incurred, or there are maybe some capital projects that impact directly on their cost of sales that impact their gross profit. So that is the risk that you are looking at. So in doing this ratio analysis, the risk is what we look at the tail end of it all. But then you have to be able to interpret the ratio to be able to know the risk that comes out of. That's why at the earlier stage I said that ratio analysis is for risk assessment. But it's interpreted based on the client's information and the kind of ratio you have. Okay, so that as an auditor, using your professional judgment, you'll be able to interpret and know the risk associated with that particular ratio you have computed. So I cannot give you a risk associated with every ratio, but then based on the interpretation, you can tell for the taxpayer specific information. So in exam, the examiner normally would ask you to interpret the ratios. I'm yet to see where the examiner takes you ahead to say, okay, based on the interpretation, you can maybe bring out some risks. And it can be a nice question, because that is the focus of risk ratio analysis, okay? But the most important thing is knowing the interpretation. Once you know the interpretation, you are able to know where the risk assessment lies. Are you okay?
Yes, please.
All right. So I was talking about quick ratio. So quick ratio, we are looking at how best the company is able to cater for their liabilities using their most liquid assets. So if I say most liquid assets, there are some current assets that are not liquid enough, like inventory. So you keep your goods in a warehouse. It will be difficult for you to convert them into cash. That's why we say they are illiquid. If people are not come to buy your inventory, it still stays as inventory. But your debtors, you can chase them for your money. You can go to your bank and withdraw your bank balances. Okay, so normally we take inventory out when we are looking at your most liquid asset. So quick ratio is given by the formula current assets minus your inventory divided by your current liabilities. Okay. Once this ratio gets better, 2:1, 3:1, it means that it is better for the company. But once it reduces 0.2:1, 0.3:1, 0.9:1, it is not good for the company. And the interpretation for quick ratios are how the company is able to settle their short-term liabilities with their most liquid assets as and when they fall due. Activity or efficiency ratios. We are looking at how efficient the company conducted business. So here we are looking at inventory turnover period, debtors collection period, creditors payment period. Let's pick inventory turnover period. Here we are looking at how well the company is able to turn around their inventory into sale. So how many days does it take the company to move items from their warehouse into sale? Okay, so if it takes the company longer times to sell their produce, it is not good for the company because then there's a longer inventory turnover period. But then if it takes the company shorter time, it means that then that should be translating into revenue. So these ratios are very linked. If your revenue is increasing, you will expect that, oh, this company is also doing well, is able to sell things quickly. And as those of us who are not accountants, revenue in the company's financial statement does not mean things that their customers have paid for. If a customer buys your inventory and the customer hasn't even paid, it goes to your revenue, okay? So revenue is made up of payments that had actually been received in cash or transfers or whatever, and payments that are in that are owed, okay, to your customers. Okay, debtors collection period. If this is the number of days that it takes the company to take its debts from its customers, so someone should tell me, if you have a long debtors collection days or period, which means that you have long time to take your monies from your customers when they buy on credit, and you having shorter times to take your money from your customers. So longer debtors collection days and shorter collection days, which one is better and why? Abigail.
Yes, please. With a longer collection period, it's bad. That is okay. No, it's good for the company because the
if it
money
takes
that
long
we
to
are
get your money from your
your
customers,
debtors,
yes,
then it's bad. It takes long, it is bad because
good.
if it takes shorter, you could have used the money for some short-term investment and you get interest on it.
Good, good. So it even helps you with your cash flow. Once the money is coming and you're able to turn it around also to buy more stuff and invest into your business. But for creditors payment period, which looks at how long it takes you to pay your creditors, right? If it is long, it helps you because you have more time to turn around yourself with a little you have and pay your creditors later. But if your creditors payment period is short, it means that the moment you buy things on credit, your suppliers are on you taking their money, which is not good. Okay, but there are some factors that you need to consider as a company with longer creditors payment period. Even though your suppliers will be happy you paying late, sorry, your company will be happy you making late payments, and the supplier would also not be happy in that instance because then it takes long for him or her to receive money from the company. When it happens that way, as taxpayers, this is advising from the perspective of a taxpayer. Taxpayers shouldn't take advantage of longer, should not take so much advantage of long creditors payment period because you can lose out on discounts. The taxpayer might not be giving, sorry, the supplier might not be giving you things on credit again. You might attract interest for late payment and all that. So you should be able to communicate during these longer creditors payment period. This is just like an advice to taxpayers who have this kind of like schedule. It takes time for them to pay. Let's communicate with them. Let's make sure we are not overdoing it to lose out on discount and to lose out on like more credits in the future. Okay, leverage or gearing ratios. Leverage or gearing ratio, as the name suggests, if I say a company is highly leveraged or a company is highly geared, it means that the company has a lot of debt in its capital structure, debt in terms of loans. So this ratio is looking at the kind of loans that is inherent in the taxpayer's business. So total debt ratio, you're looking at the total debt in the company's capital structure. Debt to equity ratio is looking at debt, that's loans, long-term loans normally, as compared to the company's equity. Equity is made up of income surplus and stated capital. Now, this ratio is just to tell us that companies are having, let's say, this amount of loans, this amount of debt in their capital structure. Normally, for tax audits, we are also looking at risks like transfer pricing risks, where companies take loans from related parties and the interest associated with those related parties are not subjected to thin capitalization or are not subjected to proper interest rates that are on an arm's length basis. I'm sure international tax will be doing justice to some of these principles. So just to have a feel, you take loans from related parties during the tax audit risk assessment, computing this debt to equity ratio, the company is able to see that, oh, there's a lot of debt in the company's, the tax auditor is able to see there's a lot of debt in the taxpayer's capital structure. It took it from a related party. It is able to tell you, okay, this company has so much debt, which is not good for them. Is the interest high or low? Normally, there's this thing we call BEPS, base erosion and profit shifting. I'm sure you learn it in international taxation, where the companies, because they are related in different jurisdictions, they'll be shifting profits and all that. If I want a related company in Ghana to be paying small tax, what I can do is I'll give them a loan. And the loan I'll give to them, I'll charge a high interest. Maybe the commercial rate of normal commercial loans in Ghana is 30%. The related party will charge the related entity in Ghana, let's say 45%, so that there will be a high interest expense. And you know that once there's a high interest expense of finance cost, it reduces your revenue, it reduces your profit, it reduces the tax that they pay. So normally companies have these structures, or multinational entities have these structures to reduce the amount of taxes their other related entities pay in other jurisdictions. So all these things, when you are doing your analysis, you're able to see them well and be able to come up with plausible risks that are envisaged in the taxpayer's business. Investment ratios, these are just to guide any taxpayer, anytime, any investor, anytime you want to make an investment in a company. So you are looking at their earnings per share, dividend per share, price earnings ratio. These ratios give you a fair idea of how investment in these companies are. Are their share prices increasing? Are their dividend per share increasing? Are their earnings per, are their PE ratios increasing? These are telling us that these companies are good for investment. These companies are doing well. It can even happen that after computing these ratios, tax auditors can see that, oh, this company is not doing well. So maybe let's envisage a planned liquidation because the company is having a dip in their share prices. They've not been paying dividend for so many years and all that. It can even be a situation where tax auditors can even say this company is not even worth auditing in the current year, because note, anytime GRA does an assessment, sometimes they can say they will not proceed to do the tax audit because the number of staff GRA has cannot audit every company every year. That's why some companies experience tax audits 3 years at a go. So they'll come, let's say 2022, they are auditing from 2019, you get it? Because they do their risk assessment and they want taxpayers that are risky before they do their audit. So seeing a company that are not forcing, they are going to liquidation and all that, maybe they might not be interested in even carrying out the audit. Or if the company is winding out, then they'll be interested to say, okay, the company is even on the verge of winding out or winding up. Let's get to do the tax audit to see last tax liability we can have for these companies so that they can move out of the country or something. Ratio analysis used in risk assessment has two, so you can distinguish it using the internal and external aspect of ratio in risk assessment. So looking at ratio analysis used for internal purposes, you are talking about the company's management using ratio analysis to know how, let's say, they are looking at their staff salary as against their revenue, or their costs as their staff salary as against the total cost of the company, knowing the component of, let's say, their wages and salaries out of their total expenses, just to know whether they are being efficient, whether they are paying their staff well. Those are internal matters. External matters, now you are trying to compare your company's information to other companies' information or the industry information, just to know how your company is performing and all that. So comparing the company ratios to ratios of other companies. So ratio analysis can also take these forms. It can be used internally or externally. And this is a past question. And this is a past question. So let's take notes. Okay. Let's look at audit risk at this point. Audit risk, basically, we are referring to three main risks: control risk, inherent risk, and detection risk. Okay. So whether tax audit, whether financial audit, audit risk remains these three risks. Okay. Now, inherent risk, we are talking about risk that is inherent in an item. So for example, if you want to go and do a tax audit on a bank, you know that banks, they will have loan defaults because they give out loans and people will default on loans. So it is an inherent risk with the banking business to have an inherent risk of what? Of, how do you call it? Having loan defaults because they give out loans. Control risks. In the process, management puts together or put in place some control procedures that helps the entity prevent some of its risks. So for example, if management of the company sees that they are experiencing a lot of thefts in their pharmacy, let's say they operate a pharmacy. So theft in the pharmacy, what do? They have to put in place a control. So for example, they segregate duties. They bring in someone who takes the money, someone who sells to the customer, and someone who banks the money. That is a control to prevent what? Theft from happening. Now, there is a control risk when, after putting in place this control, still people are stealing from the business and theft is not controlled. So the control risk is when control procedures put in place by management is not able to avert the risks that they envisage. So in this example I gave, that is theft. Detection risk, we are talking about audit procedures not able to bring out tax audit liabilities at the end of the day. It means that there's a risk in the business, in the audits we have done, which is audit procedures not being able to detect tax malpractices, tax evasion activities, tax non-compliance activities in the taxpayer's business. So that is detection risk. Taxpayer's risk. So there are specific risks that is applied to the taxpayer. Taxpayer risks, we are talking about registration risks, declaration risk, filing risk, and payment risks. Let me give you one sentence to cover all these risks so that it helps you in quick assimilation. Taxpayer risks, I'm referring to if a taxpayer, before you become a taxpayer to be paying taxes, you need to register with GRA. Once you don't register with GRA, it means that GRA stands a registration risk, because then you haven't registered to be able to start paying taxes. If you register, you need to declare your income so that you can be paying taxes on it. Failure to declare your income in part or full is a declaration risk. If you declare your income, you must file your returns. Failure to file partially or fully your returns is what? A filing risk. If you file your return, you have to pay. Failure to pay for the return you have filed or the amount of tax due in part or full is what? payment rate. So these are the 4 taxpayer rates, and the examiner likes it a lot. Okay, so let's take note. Now, at the end of it all, we are exposed to coming to the end of the planning activities. We have done our risk assessment, we have done our pre-contact procedures, we've stored the company's business, we've done an initial visit to the taxpayer's premise, we've done all that. Now we can start field work. We need to start field work by what we call an entry conference. So at an entry conference or an entrance meeting, the taxpayer have a discussion with the how do you call it? They have a discussion with the management of the company, their key people, then how to begin the audit. So there are some matters that are normally discussed during the entrance meeting or the entrance conference. So you can ask about how the company has performed, the impact on their revenue. You can ask about key people you are going to be dealing with during the tax audit activity. You can ask them about whether there had been a previous tax audit and have they settled the liability, or are there any impending legal or litigations against the company. You can ask them. You can even on the entrance meeting, because it precedes the field work, you give the company a tall list of documentations you need in terms of information requests, what you need to be able to carry out your audit, who will be your main person, your go-to person in case you need anything. Okay, so all these are things that you discuss during the entrance conference or entrance meeting. Okay. Quality control. So quality control has been one of the topical issues of late in the audit environment. I don't know if some of us are aware, those of us who are in the financial audit space, you see that the IASB board has issued new quality control standards, okay, for accountants. And normally this will apply to financial audit, but then it brings our mind to quality when we are also doing tax audit as well. So these quality measures are just to remind us that as auditors, we need to maintain quality in the work we do, because once we are certifying people's financial statements, we should be doing the right thing and maintaining quality. Otherwise, then we are also not trying for ourselves.
I had some kind of secret. So the next day, as soon as I got to.
So as auditors, we need to maintain quality. And normally quality control is seen at 2 levels. 1, at the firm level, and 2, at the individual assignment level. So at the firm level, if you are a tax practitioner or a tax practicing firm, the firm should know that whatever it does should be of good quality. If you are an individual, if you are talking about the individual assignment level, individual audits we do, the work performed on individual audits should also have quality. So quality control is broken into 2. At the firm level and at the individual level, there are basic elements of quality control: direction, supervision, review, independent review at some point. So all these things are elements of quality control. If you want to maintain quality, you need to ensure that your team has direction, the assignments are well supervised, review of work is being done so that teams will know what they are not doing right, and they will correct it in subsequent assignments and all that. So the call will be ending soon. Let's join back. Then let's discuss quality control at the firm level.